Have you ever wondered what really happens in that split second after you click buy on a stock? It's not just some digital magic. It's actually a lightning-fast, invisible battle, and it's fought across this incredibly complex digital landscape. So today, let's pull back the curtain and dive right into this hidden world, the world of market microstructure.
So, here's how we're going to break it all down. First, we're going to map out the invisible game board and figure out its rules. Then, we'll meet the players, all of them, and understand what drives them. After that, we'll take a look at the wild, fragmented digital arena where all this action happens today. And finally, we'll get into a winning strategy just for you.
All right, let's jump right in with part one, the invisible game board. It's time to uncover the fundamental rules that govern every single trade you make. Seriously, that one simple click, it kicks off this whole chain reaction. It's a super complex system of rules, cutting-edge technology, and raw human behavior all colliding in a fraction of a second. So what do we even call this system?
Well, it's called market microstructure. Think of it as the secret blueprint of the market. It defines literally everything. How prices get formed, how much it actually costs you to trade, all of it. And this isn't just some boring academic theory, okay? These rules directly impact your wallet. They determine where liquidity comes from, what your real transaction costs are, and even how volatile a stock is. Understanding this architecture is really the first step to becoming a much smarter player in the game.
Okay, so now that we have a sense of the game board, let's talk about the players. Because, and this is important, you were never, ever trading alone.
Professor Larry Harris, who is a giant in this field, he puts it very bluntly. Trading is a zero-sum game. Where some traders win and others lose. Now, this is totally different from long-term investing, where a rising company can make everyone a winner over time. Nope, short-term trading is a direct transfer of wealth. For every single dollar a trader profits, another trader loses a dollar. The stakes are incredibly high.
So the whole game really comes down to understanding this divide. At its core, the market is a clash between two major groups. And it's not about who's smarter, but about their reason for trading. On one side, you have the informed traders. These guys have an edge, maybe better analysis, maybe faster data, you name it. Their whole goal is to profit from what they know that others don't. And on the other side, well, that's the uninformed traders. They aren't trading to speculate on a secret. They're trading because they have to, investing for retirement, hedging another position, or just getting some cash. They are the ones who provide the liquidity that actually keeps the market running.
And this brings us to the single biggest fear for anyone providing that liquidity. It's called adverse selection. It's that nagging risk that the person on the other side of your trade knows something really important that you don't. This risk, this fear, is the #1 reason the price you can sell a stock for, the bid, is always lower than the price you can buy it for, the ask. That gap, what we call the spread, is basically the market's insurance policy against getting fleeced by an informed trader.
And believe me, this ecosystem is packed. You've got the buy side, that's us, the retail investors, but also massive institutions. They go to the sell side, the brokers and dealers who actually execute the trades. And then in the middle, you have intermediaries like market makers who literally create the market. But here's the key takeaway for today. A lot of these roles are now completely dominated by the modern players, high-frequency and algorithmic traders who operate at speeds we can't even begin to imagine.
So, we have our players. But where do they actually play? Well, that brings us to our next section, today's fragmented arena. Because the place where trading happens now, it looks nothing like it did even a few decades ago.
I mean, just look at this evolution. We went from the open outcry of floor-based trading, people literally shouting orders at each other, to an electronic system. And now we're deep in the era of fragmented, high-frequency trading, where algorithms are the main go-betweens. And the next big thing is already here. AI-integrated systems that are basically teaching themselves how to trade. The speed of change is just staggering.
Now, a huge feature of this new world is fragmentation. What that means is a single stock, say Apple, doesn't just trade in one single place. No, it trades at the same time on dozens of different platforms. Public exchanges you've heard of, like the NASDAQ, but also private ones called dark pools, where the orders are completely hidden from the public. And the competition between these venues for your order is incredibly fierce. So, markets today pretty much run in one of two ways. The most common is the order-driven market. The easiest way to think about this is like a continuous auction, where the system is just constantly matching buy and sell orders. But then you also have quote-driven markets. These are more like a store. You have dealers or market makers who post their prices, their bid and ask quotes, and you just trade directly with them, just like buying something off a shelf. Okay, so
We've got this complex, ridiculously high-speed, fragmented battlefield. How on earth can a regular retail trader even hope to compete? Well, let's talk strategy.
Look, your goal is not to be faster than the algorithms. You can't. It's impossible. Your goal is something called best execution. This is actually a regulatory term, but you should think of it as your #1 mission as a trader. It just means making sure your broker gets you the best possible deal. And that's not just the best price, but the best overall combination of price, cost, speed, and the chance of your trade actually getting filled.
So how do you do it? 3 key steps. First, you have to master your order types. A market order gets you speed, but the price is a bit of a gamble. A limit order gives you total price control, but there's no guarantee your trade will ever happen. Second, understand your real costs. The commission fee is obvious, right? But that bid-ask spread we talked about, that's the hidden cost you pay for getting your trade done right now. And third, know what your broker is actually doing. They use these complex algorithms called smart order routers to hunt across all those fragmented markets. And it's so important to understand their incentives. For example, do they get paid for sending your trade to one specific place? Because that can sometimes be at odds with getting you the absolute best price.
So let's tie it all together. Why does any of this matter? Well, because bad liquidity means you can't get out of a trade when you need to. High transaction costs are like a constant leak, draining your profits. A market that doesn't have informative prices means you could be making decisions on old news. And volatility, which is often driven by the market structure itself, can wipe out your entire position in seconds. Every single one of these things hits you directly in your account balance.
Which really leaves us with one final thought to chew on. We've built the fastest, most technologically advanced markets in all of human history. They are incredibly, undeniably efficient at processing millions of orders a second. But as we've seen, it's a complicated, fragmented battlefield. So the real question is this. In this relentless pursuit of pure speed, have we built a market that's actually fair, or is it just fast?